personal finance.
Warren Ingram from Galileo Capital. I've got a great question from Randall this week. Now, Randall sent an email. He's saying, over the past few years, my wife and I have accumulated a 7-digit sum of cash, which is currently sitting in a 7-day call account with the bank. Now, 7 digits, that's like over $1 million.
It's at least $1 million.
That's a lot of money, Randall.
Yeah, well done.
Sure. Okay.
Should we give out his cell phone number?
You go wrong for handouts. It's sitting in a 7-day call account in a bank, which means he's probably getting what sort of interest rate?
North of 7.5%, and it could be as much as 8.5%. Somewhere around there.
Let's call it 8%. So he's getting 8% interest on R1 million a year, which makes let's say he's getting 80,000 Rand a year interest, which puts him into a different tax bracket, doesn't it? Because it means that there's an allowance that SARS will give you in terms of you can get interest-free, you get tax-free interest of what, 20, 30, 40,000?
I actually don't know.
Okay, it's in that. No, it's fine, but it's in that sort of space. He's now earning in excess of the interest he can earn tax-free. So now he's paying 41% of this interest. He's giving now back in paying in taxes. So in real terms, he's actually getting less than 5% return.
And that's the issue. At the moment, you see some of the banks advertising fixed deposits of between 8 and 9%. And 9%, if you consider an inflation environment that we have now of, let's say, 6%, that's a return of 3% above inflation. It's extremely attractive when you just look at it like that cold.
So if you're investing 10,000 Rand, that's a nice interest rate, and you're not going to pay any tax on the interest. If you're investing 100,000 Rand, you won't be paying any tax on the interest. But if you've got Randall's problem and you've got too much money, which is a nice problem to have, suddenly your interest that you get isn't all yours. You have to give some of it to SARS. And
now he's definitely in a position where the buying power of his money is just gradually eroding over time. And in a year like we've had now, the last 12 months, he would feel, I think probably quite good about it from the point of view, as we've just heard. Residential property is not doing well. The stock market's down over the last 12 months. The listed property market's down. Pretty much everything's down. And so you sit in this position where actually at least your investment's going up. The problem he's got is if he stays invested like that over a 3 or 4 or 5 year period, the buying power of his money will be significantly eroded. So he's got certainty right now. It's certain that he's going to get a decent sort of movement of money going up every day, every month, every year. But what he is also getting is he's buying certainty, that is the buying power of his money is reducing day after day.
Because the return you get when you've got lots of cash is not the return you receive because of those tax implications. So he's now looking at it, and so many people have got this problem because they look at the investment universe and they look at the multiple names of companies. If you pick up a JSE handbook or you do a Google search saying investment companies South Africa, you're going to get dozens.
Yeah.
And most of them are very good. And most of them, there's little between them, really, in terms of what they offer. But you've got multiple investment companies and then multiple products within those investment companies, all called very strange names. They might all do the same thing, but they've got different names. And it becomes an absolute jungle for people like Randall.
Yeah. And so I think let's just maybe go through the range of options. Firstly, I just wasn't sure if this money is only in his name, because the very first thing he should be doing is splitting it between him and his wife. So if they each have this sort of size of money in their own names.
So if there was R1 million and they each had 500,000 Rand, they'd have much less of a tax problem because in their own names they would be earning less interest, and therefore it might not even be taxable.
So that's
simple solution.
Yeah. So that's the first thing that he should be doing as a matter of course, irrespective of whatever else he listens to after this. Definitely split the money unless they've got other money as well. And then the second thing is, if you're trying to beat inflation over time, that means you have to have a portion of your money invested in growth assets. And those are things that have got a really good history of beating inflation.
So like property, no, not property this year. Like the stock, no, not the stock market. Like a bond, no, not the bond market.
You sound like some of the unhappy people I've been speaking to recently.
But that's the reality, that the JSE is down 3% year on year. But as we discussed last week, you add inflation into that, actually your money is worth 10% less than it was this time last year. You're poorer. And you put it in the stock market.
And for someone like Randall, who's been accustomed to seeing his money only go up, it's going to be extremely uncomfortable to do that. But you have to have exposure to growth assets. So listed property, normal property, and then shares. And to me, it's quite difficult to buy to buy the physical property. I think that's it's always the transaction costs there. I think are an issue. And if you're not young, you need long periods of time for that to grow. So I'm just going to focus on the things that you can buy and sell more easily. So now we're in the share world or the unit trust world. And to me, the absolute minimum that he can invest in growth assets would be around 30 to 40% of that million rand. So 300,000 to 400,000 rand must be in growth assets in order for you to be reasonably certain that you're going to beat inflation over time.
Okay, so in when you talk about growth assets, you mean either buy an index fund, you either go and you buy an index tracking fund, or you go to Satrix and you buy one of their products, or you go to a Signia and you buy one of their lower cost products, or you go to a unit trust company and you say, I want a human being to manage my 300,000 or 400,000 rand, and that's fine. Then you choose a unit trust company.
Okay, but let's just stay there for a sec. So right. I'm certainly not saying just do that in piecemeal. I think he probably wants his life to be somewhat simple as well. So I think if we look at that 300,000 to 400,000 in shares, then in the unit trust world that would be called a moderate fund, and I know they've got terrible names, or a conservative fund, or so it's those kinds of things. Is that also known as a balanced fund, or is that something different? No, that's something different. So okay. So moderate or conservative, or stable is the other jargon that they use for those kinds of funds. So if you see a unit trust company advertising their stable fund, this is now talking to this person now, and that means that they already control that you can't have much more than 40% or 45% in shares. So at least you're not going to be sitting there if we get another huge market crash and now you lose half your money. That's where the balanced funds would kick in, because the balanced funds can have probably double that amount, up to 75% in growth assets. So I think he needs to be looking at the very, very, very least at that kind of a thing. Or he can, as you say, go to buy an exchange traded fund that has 30 or 35 or 30 with 30 or let's say 30 to 40% in shares, and then he can buy more exchange traded funds that give him bonds and property exposure there. And
now he's an optimistic guy, is Randall, because he says, please can you explain the sort of investment vehicles which give me the best possible return but have the lowest cost of investment, which is important. And we've touched on this many times in the past in terms of watching the costs that you pay. And then he's quite convinced he's going to make lots of money, so he wants to make it tax efficient.
So I think that's why I would suggest that he does make sure that everything's wrapped up into at least one fund, one unit trust as an example, because when that unit trust is changing between cash, bonds, property and shares, and earning dividends and interest, etc., those things are earned within the fund. And that's quite an important point, because he's not earning all of his interest on the whole million. He's only going to be earning interest on a portion of the money, because other portions are in bonds, and then and another portion in property, and then in shares. And shares are far and away your most tax efficient investment, because they're going to pay you dividends, and the dividends only attract a tax rate of 15%. For now, yeah. So from that point of view, he's in a space where at least his real taxable income on a month to month or year to year basis is going to be better. If he wants to be really tax efficient, he can take a notch of risk more. He can go into the balanced fund world. But I'm just concerned if he doesn't really know much about investments, and now we go from 100% cash to 2/3 in shares, the next market drop might cause him to make a bad investment decision at the wrong time. Okay. So in an environment like this, I would stay in that stable, conservative world.
And again, don't be scared to use the tax-free savings accounts which are available. You can take exactly the same unit trust investment with exactly the same company, but put 30,000 Rand a year of your money into the tax-free savings option that particular company has got. And you'll get exactly the same return. You'll get exactly the same thing. But that 30,000 and next year's 30,000 and 3 years' time there's 90,000 plus some growth. There's real money in that tax-free savings account. You can do that on the side as well.
The trick is as long as he doesn't need income.
Yeah.
So if he needs income from this money, and that's what's concerning me, is I think if he's been earning interest, he's probably been using the interest. And so that will be the only issue, because the tax-free saving, great investment. It takes 16 and a half years to get to your lifetime allowance of 500,000, and you really shouldn't be putting it in now to expect a return and to start drawing on it in 3 years' time. It doesn't really give you a heck of a lot of growth. So I think if he's drawing an income, again, that's why the unit trust world works, because there you can start selling units every month, which means you're actually paying capital gains tax, which is far and away the most efficient way to generate income. And in terms of costs, you're quite right. I think the index space is important there. So there are index tracking unit trusts that will meet his requirements already, all the conservative unit trusts. And I think if he's really cost conscious and he is a do-it-yourself kind of a guy, there are lots of unit trust companies that you can actually go to directly to try and then cut your costs as low as possible.
Warren Ingram from Galileo Capital, and I can't punt his book nearly enough, and he goes a bit pink in the face when I do, but his book, How to Make Your First Million, Randall, is really your starting point. So have a listen to the podcast 3 times, then make sure that you take some of the money and you go and spend 200 and something rand on the book, How to Make Your First Million. Read that book 3 times and then apply the rules and the lessons from it, because it is simple. We've used lots of words like stable funds and balanced funds and general equity, and we've used terms like indexing and all of that sort of stuff. All of that is explained in the book. And we can't go doing the entire glossary of terms, unfortunately, on the radio every single time. But to get familiar with the terminology of these big companies. So the first job, pick the company with which you want to invest, then understand the sorts of product that they've got that you could invest in, and then talk to some people, get some advice on the stuff. It's really important. You don't want to be making bad decisions, especially on big amounts of money.